I'm not that excited about the market. I'm really excited about internal moves. I'm really excited on banks or regionals on a relative basis. I'm really excited about dislocations and factors because people lose their minds over recession risk or not, and how to take advantage of those dislocations. But as far as the overall market is concerned, I think it's a pretty unexciting seventh inning like returns.
Well, welcome to the On the Tape podcast, guy. Adami, Danny Moses. Danny, how are you?
I'm good. How are you guys?
Dan? Great. That's all you want to say.
Is this in 2X? You know, when they do the thing on Spotify?
I can speak very quickly, as you know, but
Yes.
I'll tone it down a little bit because we have a lot to talk about. By the way, one of your dear friends, Danny Moses, Dennis Debusschere. We're going to speak to him later.
22V.
Dennis from
22V.
V, as in victory.
He worked under Ed Hyman at ISI. Brilliant guy.
What did you guys cover?
Covered everything. We covered his correct call for no recession last year.
Okay.
We're going to get his thoughts on that.
Yeah.
Just GDP kind of growth, pockets of...
So he's a macro strategist.
Yeah, he's really good.
Broke it down. By the way, he did a great job in July of last year. He was sort of a bit of a soothsayer in terms of what
And you
he
always
thought.
like to be around a Debusschere. I know how you are. You idolize his father.
Of course I did.
All right.
As most young... Think about it. I'm 60 years old.
Yeah.
In 1969, the New York Knicks won the NBA championship for the first time. I was young. I don't remember. In 1973, they won again against the Los Angeles Lakers.
And you remember that one.
I do remember that one.
All right.
That's neither here nor there. Here's a little bit of a pop quiz for you both. Dan Nathan, 105 2nd Avenue on East 6th Street in New York City. Mean anything to you?
McSorley's
No, it's not. It's good. It's good.
What was the address again? I'm not right.
I'm going to say 2nd Avenue and East 6th Street in Manhattan. Anything? No?
CB.
That's very good. That's very good. Incorrect.
Oh.
That is the former home of the Fillmore East.
Okay.
You're looking at both of you.
Yeah.
Of course.
in
Dad used to play there.
There was a great concert there recorded live. Who was it?
1971.
Yeah, good album.
At Fillmore East.
Yeah.
The Allman Brothers.
Yep.
Thank you for remembering that.
Yep.
Allman Brothers, by the way, is one of my top 5 bands of all time. Dan, as you know, I probably have 30 Allman Brothers songs on my now 900 song Spotify playlist.
It's my father was a gambler down in Georgia. It's literally my biography. Please continue.
I will.
All right. Yeah.
Because the third song on that live album on the first side, if memory serves, 8 minutes and 31 seconds long, Stormy Monday.
Oh, nice.
And we had a bit of a Stormy Monday this past week. Now, the next line of that song is, and Tuesday's just as bad. As it turns out, that wasn't the case. But let's start there, Dan Nathan, because we saw what can only be described as the stormiest Monday in quite some time.
Yeah, it was one of those days, and Danny, you'll kind of remember this. You remember those, they had those stop gaps. What do they call them? When the markets were selling off to kind of control the pace of the sell-off. They were circuit breakers.
Circuit breakers.
And they really, they expanded those dramatically. I want to say, after the financial crisis or so. And, Monday morning felt like in the pre-opening, we all wake up in the morning, we check where the futures are right away. We see what happened overnight in Asia or Europe and the like here. And it just kept on getting worse and worse in the pre-market, right? And, ironically, it all crescendoed on the opening of the market. Some of the kind of most crowded names had these huge gaps lower. And those are some of the situations where I don't know how you're pressing shorts or selling longs at that sort of point, because that felt, Danny, like an all-out panic on the opening. And since then, it's been one way, bottom left, upper right.
Well, first of all, who else had circuit breakers was Schwab, Fidelity, all the online brokers for some reason. There should be an investigation into that, by the way. I'm not a conspiracist by nature, but imagine being a retail investor not being able to trade. You could argue it benefited them potentially.
Listen, hold on. It's a tech thing. It's not like
I don't care. It doesn't.
Thing. I know, but
if you're going to spend if you're going to spend money on one thing as a retail broker with all this technology and online trading, what should it be? It should be in your tech. Anyway, with the exception, Dan, of the largest reversal in years happening intraday yesterday on Wednesday, right? We're right back here now where we were at Wednesday's highs yesterday as we sit here on Thursday. Yeah. So we've had a little bit back and forth, but you're right. The market has tried to recover. It's amazing to me how many people now went on to Investopedia and read about the yen. It's amazing all of a sudden. So we've gone from the number one factor being 10-year yields.
Right.
That would go down, we buy the market. Well, guess what? The market went down and 10-year yields went down. Now it's the yen. Now all of a sudden, if the yen weakens, which means it moves higher for people out there, back from the 142 level towards the 150 level, 147, 148 here, that's an all clear sign. But what's interesting about that is now it's the other side of Goldilocks. What do I mean? It means if our labor market actually stops getting worse and starts to improve or whatever, then what happens, right? We're back to no rate hikes, no rate cuts coming potentially to the market. So now you're battling with what I can only deem to be just central bank arbitrage guy. And I go back, I'll end with this. I go back again to Liz Truss in September, October 2022. She came in, tried to cap energy prices, wanted to cut taxes. They destroyed the sterling. Rates went up. They got rid of her to try to stop that from happening. What happens in Japan? Not the bank, someone comes out from the Bank of Japan and says, we're just kind of kidding. Obviously, if there's turmoil in the markets, we're going to still be dovish. So, but I'll say this. You think that the U.S. Federal Reserve has been dovish over years? So people that haven't paid attention to the Bank of Japan, that's the most dovish bank in the land.
And you've talked about this last July when Dennis was on with us. You had made the comment, if memory serves, that there'll be a scenario where rates go lower, but that's going to be deleterious to the broader market. And to a certain extent, that's what we saw. So let's break a couple things down. The yen trade, the carry trade, something that Danny and I have been focused on in terms of what it could potentially mean. But Dan, we saw the volatility index, the VIX, which has been floundering in the low teens seemingly forever, traded up to about 60 or so on Monday. And as we're sitting here today on Thursday, it's below 25, still extended by what we've seen, over the last year or so, but obviously nowhere near what we saw on Monday. What is that?
Yeah, so when you think about the VIX, right, it's kind of pricing the volatility of the underlying S&P 500, right? So we had this situation where, into Monday, I think the S&P was down, 6-7% or so. You had that gap opening to the downside, VIX explodes here, right? So these things are meant to move, in opposite sort of directions. Now, what's interesting to me, at the lows, the S&P was down about 10%. You saw VIX go from, I think 2 weeks ago, around 13 to above 60. Now, anybody who watches these correlations knows that that's not going to stay for too long, especially if there's not some sort of systemic risk in the market, right? And so I think the fact that our unemployment rate got our market going lower on Friday, but it was exacerbated by what happened in Japan over the weekend. There was kind of some sort of calm that should have been about investors that we weren't going to have some sort of 08 sort of situation, right? So the VIX spikes, the S&P actually, made a bottom that morning. And I think the most important thing to remember is that the 10% drawdown in the S&P happened in less than a month. If we go back to the summer of 2023, when we topped out around a similar time, it took 3 months basically to go down 10%. So the move in the VIX higher was much more gradual. It didn't speak to any panic, I guess is the way I'd put it.
Danny, you've been on Fast Money recently, and on the last time you were on, both Vinny, Daniel, and Porter Collins were on the show, and one of the things that they thought for the remainder of this year, and they talked about it, make volatility great again. And I think little did they know that they'd be so prescient in that call. Maybe they did know. But they're talking about volatility in the form of the VIX, but volatility in some of these underlying names as well. And that's what we're seeing. I mean, what are your thoughts? Is this the beginning of something, or is that the crescendo of the end of something?
First of all, it's always, I think the VIX is the tail. I think that the market wags it and then the tail, because it's just a measurement of what's going on in the market. So I'll just say that. And I will say that the good thing about volatility, and I will tell people, it's not just volatility when the market goes down. It can be volatility when the market goes up. And the VIX can go down, the market goes up, but volatility is still high in terms of these massive moves in the market. But what it does is gives you opportunities on both sides of the equation. And if you just look from a stock picking perspective within the same sectors, Lilly and Novo, Fortinet and CrowdStrike, Uber and Lyft, Warner Brothers and Netflix, if you just look at the sectors about passive investing versus active, take advantage of these opportunities. Look what happened. Those stocks that I just mentioned all went different directions when they just reported in the same sector. So volatility brings that out, right? You get overly punished when you miss in a volatile world. But again, price discovery is a powerful tool here.
Yeah.
And so
I guess the one thing I'd say about that is, like, if you do get into a period though where there's going to be a sustained sell-off, correlations go much higher, right? So when you think about that, you could say, oh, Lyft versus Uber, Walmart versus this, they'll all go down. You know what I mean? It's just whether they go down as much as each other, right? And I think that's a really important point, because we haven't been in a period like that for a while. As orderly as the 2022 sell-off was, we were only down, I think in the S&P, down 25% or so. But importantly, some of the most concentrated names went down 50, 60, 70%.
it always amazes me, though, Guy, people literally crying on Monday for the Fed to make an emergency rate cut. I know you guys talked about it on Fast Money this week and on Market Call, right? But I'm only here once a week, so I need to opine on this. the measure of the moral hazard that's in the market's insane.
Mm-hmm.
And if you're that concerned, then you own too many equities. If you're that concerned about the markets moving like this and you want an emergency, the fact of the misunderstanding of the plumbing on what would happen if you actually did that to the point that you made, Guide, on TV, I want to hear your thoughts on that, because that would only pepper up inflation back up, and this whole thing would be,
Well, we've talked about this for a long time. Be careful what you wish for in the form of rate cuts. And what is, rate cuts are not some magic elixir forget about the economy, but for the market as well. And at a certain point, it actually does more harm than good. And this yen carry trade, if in fact, let's just play it out for a second, if the Fed had acquiesced and did an emergency rate cut, they would have just made that situation that much worse. They would just have accelerated what was going on. So I'm not going to say kudos to the Fed, because there was no way, shape, or form that they were considering that. But the fact that respected professors like a Jeremy Siegel, for example, went on CNBC Monday morning and was opining how the Fed should be cutting emergency rate cut of 75 basis points. The absurdity of that to me was, I lost a lot of respect for him, because the lack of understanding what it really means.
Why would anyone listen to an academic anyway about this stuff? I always wonder why he spends so much time on CNBC, because again, the guy hasn't spent too much time other than on some like ETF commercials on CNBC when he's not, lecturing students. I just want to make one last point about the VIX. So if you look at a VIX right now, that's about 24. That's kind of double of where it was just a couple months ago. A 24 reading is implying about a 1.25% move in the S&P 500. That could be obviously in either direction.
Every day.
Okay, every day. And you think about, like, when we talk about volatility bands, so back when it was 12, which was a couple months ago, it was only implying about 0.5% a move. And that's all we were getting. We kept on quoting the amount of days. I think it got up to 355, where the S&P hadn't had to close down 2% in a day. It had to take you back to Q1 2023. So here's the main point about this, is that if the VIX stays up, above 20, then expect more volatility, right? Expect the ranges to be greater. We talked about earlier in the week how some of these rallies, we get up 2%, but in the last hour of the day, we'd give back a 1%. That is going to become a mainstay of the activity if we have a VIX that remains much higher than it has been over the last couple of years.
You've made the point with Carter. I've heard you talk about it recently before vol shot up, and you said, guys, listen, we haven't had a 2% correction. No. Go buy puts on the S&P. Yeah. Here's a put spread. Go do it, whatever. And so when you're talking about now what's really relevant for people out there that are listening, what that indicates is that you're now paying a larger premium for the puts that you didn't have to pay effectively a couple of weeks ago. So for protection on your portfolio, just became more expensive.
Well, and there's a couple other things I think to mention. In some of these Mag 7 names, NVIDIA in particular, the skew towards calls was much greater than that of puts. What does that mean? If you take an out-of-the-money call, the same out-of-the-money put, the call is going to be a lot more expensive than the put. That's something that should not happen too frequently, and that should get your antennas up about this stuff. The other thing I'll just say about buying puts or put spreads on your portfolio, you have to do it very tactically, right? If you keep doing that and they go to zero, but you feel good about, the ability, that you're protected, that's going to be a huge drag on performance.
Sometimes better just to sell some.
Yeah,
sell down
and the other thing I just mentioned about this environment, and we get the question all the time on Market Caller from listeners from the pod, how to use options to protect your portfolio.
Right.
So you just made a great point of when to buy, when not to buy. Sometimes it's a great opportunity to sell. Well, so let's just say you own Apple and you bought it at 165 in the spring or something like that. And here it is at $213. And you may say, okay, the high was 230. I'm just throwing it out there a month or so ago. And I think the stock's going to be range bound. Maybe you sell a 225 call against your stock, and then you take in some premium. So that's a pretty good setup right now where vol is.
You create a synthetic dividend for yourself, and you're taking advantage of volatility that's now elevated. I agree with that. But let's talk about the consumer and the economy, because as we discussed, the trigger seemingly for this was that 4.3% unemployment read last Friday, up from 4.1%. Whether or not it triggered the Somme rule, we'll talk to Dennis Debusschere about that. I think we're sort of splitting hairs, but the economy is clearly slowing through a number of different things, Danny. The ISM, all the different manufacturing data, and the fact if you listen to some of these reports from retailers across a wide swath of spectrums, the consumer is absolutely slowing down. And we're just not seeing that manifest itself in the market yet.
Throughout Q2 earnings season, we highlighted no shortage of consumer discretionary companies, retailers, and even some of the commentary from some of the banks, right, about a consumer slowing. And Guy, you say this all the time. I've heard you say this for 15 years. I've been doing fast money. Consumer confidence is really just an overlay of the S&P 500. And I've made this point a couple times on our pods and on Fast Money of late. No matter how bad it felt Monday morning, the S&P was still up 9% on the year, right? And so like for the last 2 years, you could have thrown a dart at the stock market at your main FactSet page, and you could have made money on the stock that it landed on. You know what I mean? So it's kind of been an easy trade here. So here we are, we're still up, 10% or so. And I think about this, and I think about consumer confidence and, weighing that versus what we heard from a lot of these companies. And I say to myself, you know what? We were so wrong about when a recession was going to come in 2023. Even when the stock market was telling us that something was up, I feel like we're going to be wrong, strategists, economists, about when the recession comes to. I don't think it happens in 2024. And whether you think the Atlanta Fed GDP now is accurate or not, they just ratcheted up the current quarter from 2.5% to 2.9% GDP growth.
Well, this just came out as well. So U.S. macro update. U.S. consumer credit card debt hits a record $1.14 trillion. The average consumer now carries $6,329 in credit card debt. That's up almost 5% year over year, and that's probably at an average rate of 21.5% or 22%. Right. It's unsustainable, Danny.
Yeah, so again, if you look at the mosaic, the Disney, Airbnb, the airlines, the hotels, retailers, they're telling you that the consumer is slowing. And so I don't need to have the definition of a recession tell me what to do with the market. As a matter of fact, why you can have a recession, the stock market probably will get crushed in that, obviously, Dan. But
we won't know it's in a recession.
Exactly. My point is it doesn't have to correlate in there with the timing of it. So just do the bottom-up work on some of these names and what they're telling you. Forget about the economic numbers coming out of D.C., whatever. Listen to what the companies are telling you in real time. They're actually giving you the beginning of the third quarter trends already kind of starting here. And there's a couple names, Guy, that I want to get into at some point here.
Well, let's talk about them because, Upstart is one of them. I think what we're seeing in some of these names, which are challenged, but I think what you're seeing over the last week or so are these classic short squeezes. Everybody's on one side of that boat. People think they understand the story, I think, and they do understand the story. But with an Upstart, for example, you see a stock that goes from $23 at the beginning of the month to, I think, $34.50 today.
Well, I'm going to give you some words. You guys tell me what industry this would be a part of, okay? I'm going to give you some play word game, Guy.
I like that.
Reserves, interest rate, loans, loan funding, whole loan sales, committed capital securitizations. What sector would you put that company in?
Banking.
Banking and financials, right? Well, that's the risk section of Upstart, which poses itself as a fintech company, which has been the whole reason that I've been tracking this thing now for years. They've reinvented the AI lending, AI this, that, and the other platform, right? Obviously, short interest is very high. I've talked about it, 25 million shares or something on a 90 million share float. As a matter of fact, one of the analysts says, "Are you concerned about your share-based comp?" And CEO goes, "No, as a tech company based in Silicon Valley, that's what we do." Well, you're not. You're a financial company making loans. And they now have these risk-sharing agreements with private equity and so forth. Bottom line is they still lost $55 million in the quarter. They're not going to make money. It is what it is. The book value is will be just under $6 towards the end of the year, and it trades at six times book for a financial. My point is this: there's still these opportunities that are out there, but I don't want people to get sucked in the way that a stock moves and jump on the wagon of this thing. We were down at Fast Money in January. It was in the mid-30s, high 30s. I was short it. Went on Fast Money a couple months ago, said the same exact thing, kind of in the high 20s, low 30s. Here we are. I'm fine with it. I don't really care. But my point is that you see a name like that, take a deeper look at what's really going on.
What's funny? This stock made a high of $400 in 2021.
That was the guy that got posed on CNBC. That didn't know what he
But it's a great example where I don't know what the kind of guidance the company was giving. I'm sure the results on the way up were probably eye-popping. You know what I mean?
Transform the way people lend.
No, I know. But like for instance, but this is one of the ones that's kind of on investors. Investors were so happy to bid these stocks up and make all of these stupid justifications and go on TV and promote a stock, and they don't even know what the hell it does when they're asked about it. And so I look at it down 93%. There are no shortage of stocks, in the early 2000s that lost 90% of their value, and many went out of business. And I think what you're saying, Danny, is that this is not a sustainable business model, because as soon as we do have a recession, the defaults go up dramatically, right? The last thing I'll just say, though, Danny, I look at this balance sheet. It's not like offsides by any means.
Well, you have risk sharing. We won't get into that on this call, but but yes, they have cash they have to reserve for the securitizations. but they also have risk-sharing agreements now. So when they make these loans, it's off balance sheet. So don't go into that on the thing. But to your point, Dan, I'll take the balance sheet every single day of the week. The book value, banks don't trade like that.
Let's talk about something else where investors bid things up to absurd levels and seemingly look like geniuses, and that comes in the form of super microcomputer. The symbol there is SMCI. I mean, if you look at this stock, first of all, I don't think a lot of people heard of it up until the early portion of 2023 when AI started to get on everybody's radar screen. It's a stock that basically went from $300 a share in December of 2023. It was trading $1,229 a share, I want to say, Dan, as recently as March of this year, and it's now more than been cut in half. And this was, along with NVIDIA and a couple other names, sort of the poster child for the AI trade. And I think one of the main reasons this stock has sold off as dramatically as it has is because the contraction in margins. And that's it. It's not necessarily earnings contraction or the revenue. It's the margins. When margins start to go, that typically signals a bit of an inflection point.
Right. And in this case, it signals competition. It signals, maybe competitors that have fatter margins, their ability to compete on price. But the thing that I think is most important about this story is that there's lots of pieces of this generative AI trade that are starting to fall apart a little bit, right? So if NVIDIA was the first one to take advantage because of their market share of the investor enthusiasm about a very new investment theme. Okay, we get that. So then investors start thinking, okay, well, the chips go into servers, the servers go into data centers, right? The servers need memory, right? So there's all these different components of it, that, again, got swept up in this trade. Well, if you think about what's happened, though, over the last few months, Dell is down 40%, Micron's down 40%. The super micro that makes servers also is down 60% or so, like you said. And there's very few names other than the hyperscalers. So that's Google Cloud, that's Microsoft Azure, and it's Amazon AWS that are still participating. But what we learned in Q2 earnings from Amazon and from Google and from Microsoft is that the growth rates for the adoption of those services they're slowing a bit, right? And so you think about what's going to happen here. There's going to be less demand for servers, which means there's going to be less demand for chips, and there's going to be less demand for data center in general. So I think that's kind of playing out. August 28th, NVIDIA reports. It's going to be really important. I know we've said that for every quarter over the last few, but because of the weakness of the others in the in the ecosystem, I think it's more important than it's ever been.
Guy, what's the phrase rope-a-dope?
Rope-a-dope.
Muhammad Ali. Muhammad Ali.
That was against George Foreman.
Okay.
Because George Foreman was a big man.
Yeah.
And, he didn't think he was that intelligent.
Rumble in the jungle.
So
look at you.
Yeah.
Kudos to SMCI, Supermicro. By the way, my friend Matt sent me this. Still gets the printed copy of the Wall Street Journal. The back ad of the Wall Street Journal on Monday was a Supermicro ad, transforming retail with AI with Supermicro and NVIDIA on the back. We'll put that in the show notes. Quite something. Anyway. So obviously on all the excitement, they did $1.5 billion convert in February, and then
good for them.
And then upon the inclusion in the S&P, they raised another $2 billion in equity. All while your point, the margins were obviously going to start to get hit. I think the margins have dropped 600 basis points.
They went from 17% last year in this quarter to 11%.
So something
which, by the way, Dell's are double that, 22%.
Right. But my point is that we've been talking about this is, there's hardware, there's software, there's whatever. So it wasn't sustainable. But listen, they raised the capital. By the way, they have less than $1 billion on the balance sheet now in cash because they're spending so much, obviously, on CapEx. But just pointing out they use the money for growth, that's fine. But people bought that stock. That conversion was over $1,300 per share where that convert price on the conversion level. Just to put that in perspective, we're now, 60% below that level. So again, you get caught up in kind of this trade and the new thing or AI, know what you own, and there's better ways to play it. Sorry, Dan, than just be risk. You can get a piece of it in various other names.
Yeah, I'll just say this, though. I mean, this one's kind of been de-risked. If you think about the expected revenue growth this year, about 100%, it trades at about one-time sales. And
SMCI has been de-risked.
That's what I'm saying. Yeah. SMCI expected, earnings growth this year of 45%.
Yeah, but
it trades at 15 times. Okay,
yeah.
15 times. What I'm saying is, we've been saying that we believe in this secular trend. We just think that there's been an asset bubble in and around it, and a very narrow narrow one. So when you see this sort of thing, hey, listen, Micron, their memory might be a very key component for years to come. It may make this commodity worth that much more, right, in the years to come. But some of these things, if they keep going and keep growing to the sky, well, sooner or later they're going to crash. And we saw that with the excitement in and around metaverse into the highs in 2021, or whether it was around GPUs for crypto mining. You know what I mean? So this will have peaks and valleys, and I just think that you have to be careful and pay attention to the other parts of the ecosystem.
Oh, and the stock split. Yay. Anyway.
Well, no, the stock split was the original. I was, funny you mentioned that, because the knee-jerk reaction after earnings, I believe on Tuesday of this week, was taking the stock higher by about 7% before the market started to unravel or unpeel the onion and realize, well, wait a second, they have a bit of a margin problem. So the reversal just over that half-hour period, Dan, on Tuesday was pretty interesting.
And listen, last thing on this. We say this all the time. Just as things overshoot to the upside, they normally do it to the downside too. So if you say, 15 times expected growth of that, even if I discount that growth a little bit because, you say that there's going to be overcapacity in this space and there's going to be a slowdown, just like you said, the stock went from 300 to 1,200 in 2 months. Mm-hmm. It went from the Russell 2000 small cap index to the S&P 500. The company is selling stock or doing converts hand over fist. Well, here we are now at $500 down from $1,200. There's a good chance that it goes much lower, like it kind of retraces that whole move. And it probably doesn't have to be on fundamentals at this point. It has to do probably on sentiment in general,
So everything we've talked about for, the last 15 or 20 minutes in terms of some of the macro risks out there, Danny, and I keep coming back to it, all roads lead to gold. Now you say, well, gold was horrible on Monday. Yes, it did. When you have days like Monday where you just seemingly have margin calls and people force liquidation of things, nothing holds up, and gold was not spared. However, it's getting back on its horse a little bit, and I would submit what we're seeing today, what we're seeing over the last couple of weeks, it's not over, and I think all roads continue to lead to gold.
I couldn't agree more. We've talked, it rallied $100 off the lows a couple of weeks ago. It's rallied back again here. You're right. On the margin, when things go like that, of course, an asset's going to fall. But you think about all the things that are going on in the world, it even gives you more confidence potentially in this gold trade. So, Guy, I'm a continuous buyer on weakness. By the way, one thing I failed to mention, just as bring it back to Bank of Japan for 1 second, then we can leave it. Just for people out there that are keeping score, they own over 50% of all the outstanding debt of Japan. They own over $4 trillion worth, and they own $475 billion worth of the ETFs, just over 7%. So if anyone thinks that Japan's going to let their market go to shit, just understand how much they're already levered into it. I just wanted to point that out.
Guy, I'd love that you're asking all the questions here. So let's talk about how the BOJ blinked. Okay,
of course they did.
So a lot of this volatility, at least in their equity market, started when last Wednesday they went from a surprise hike from what the expected 10 basis points to 25, caused the Nikkei, the equity markets, just collapse. Worst day. Was it Friday? The worst day.
It was down 12%.
Yeah, over the week. So and what did they do this week? And what sort of confidence does it give you that they actually have their?
It gives me zero confidence. Number one, it's what Danny alluded to, and what we'll talk to, I'm sure, Dennis about is, we're just kidding type of thing. Listen. Danny said this since we started the On the Tape podcast. The great experiment in terms of central banks started in Japan, and that's where we'll end. And that proved to be prescient. And the fact that, a 25 basis point hike can spook markets and that create sort of this risk-off situation that we haven't seen since COVID and before that the financial crisis speaks to exactly why everything is now on a hair trigger. So to answer your question, do I have any confidence at all? No, and I think you're going to see continued volatility in the currency market, continued volatility in the bond market. And by the way, Danny, I think that manifested itself a couple times this week in some pretty miserable bond auctions here in the United States.
Yeah, the 10-year yesterday, which was not good. And you think about it not being, good. Yields came in a lot, so maybe it's not as attractive as a Gomet. And the 30-year auction today, not good. Does anyone care today? No, they care about a delta of a $7,000 less worse jobless claim number at 233 instead of 240, right? That's what they cared about today. So again, the volatility can be on the upside just as much as it is on the
All right,
downside.
so Danny, last week on the pod, you said the highs are in for the S&P 500. I think, what do we get to, Guy?
56.69.
I think the high in the S&P this year was 56.69.
Here we are at 5,300. We've talked about, the low in April. Man, it's down there at 5,000. I really thought that there was a chance that we get down there. And I think, Guy, you and I, we do the market call. We do fast money most days of the week. And we're like, listen, if you get back to those April lows, that's probably a good level. If it runs ahead of, let's say, a consumer slowdown or some sort of earnings peak or something like that, because we've mentioned this on many occasions. I mean, the FactSet consensus estimates for S&P 500 earnings this year are still up 11% year over year. I think they're close to 14% for next year. It seems a little lofty, and sometimes all you do is need a little bit of a shakeout in the S&P, put a little fear back in investors to have strategists, have economists start lowering those growth rates a little bit. We just haven't had that yet.
The logical level to me, and you mentioned sort of that 5,000-ish level, the logical level to me in the S&P 500 comes in the form of the prior all-time high that we made at the end of December, I think, of 2021, which was right about 4,800. We fell off a cliff from there for a lot of obvious reasons. We obviously got it all back. We made a new all-time high, as we just said, 5670 or thereabouts. So 4,800 to me is sort of the line in the sand, and that's 500 points from here. That's not all that far away. That's less than 10%, and I think that's reasonable.
I agree with that, and I think, Dan, you're just pointing out still some of the big companies out there, NVIDIA, which is going to report in a few weeks, still one of the largest companies in the market, so it doesn't take a lot to move the S&P if these things were to kind of correct, and that rotation that happened a few weeks ago that was, quote, deemed a healthy rotation out of big tech into the small caps. Well, what happened was that people didn't go back to big tech. They didn't, and they sold the small caps and they went into treasuries, right? This type of move. And I think that this new factor of using the yen as a signal to buy the market versus won't last. And just to tie the bow on Japan for a second, let's keep in mind they have their own house to keep in order. When the yen is weakening to the level that it was, it's very inflationary for them because they import, obviously, all their energy. So I think people need to understand we are in the bounds, and that's what I mentioned before about the other side of Goldilocks here. And so if that's what we're trading this market off, not only is 56.69 the highest we're going to see, I would argue that it's hard to see us moving much higher from here. To be honest,
I want to add something about the carry trade, and we kept on hearing. So you're borrowing yen and you're using to buy higher yielding assets, and maybe that was in the Mag 7 to some degree or whatever. But it's interesting when you look at let's look at NVIDIA right now as we're recording this. We have 30 minutes left in the trading day, Thursday afternoon. The stock is about 104. It made a panic low on Monday at about $91. It quickly reversed, and I think it closed that day around 104. So here we are 3 days later, the stock is at the very same spot it closed on Monday. That is horrible price action, in my opinion. It's still down 25% from those June 20th reversal day lows. Guy, you mentioned Microsoft. It's up less than 1% today. It's at $400, right? And so you think about some of the key components, and everyone kept on saying the rotation. Remember the great rotation out of Mag 7 into these other groups? What we saw on Friday into Friday into Monday, and we talked about correlations. I know, just go Google it, people. You know what I mean? They went to 1, right? There was nothing spared. JP Morgan was down 4% that day. I mean, Eli Lilly, all these kind of big stories that are crowded, but there was a lot of stocks that were down a lot worse.
Listen, I'll give an example of one. Can I just give an example? Because, I do buy things from time to time, Dan. So Genius Sports was a name that I pitched on Fast Money. Perfect example of a stock that gets caught up, to your point, Dan, when it goes to 1 correlation. Got down below 6 again. They just reported this week. Solid quarter, great guidance. This is the opportunity. I'm not just saying on this company in particular, but when you have companies like that you want to be there for the long haul, use this as an opportunity. Don't be scared to buy it because you shouldn't be thinking about things on a daily trade. And we'll talk to Dennis also about the washing machine of this market. If you're trying to do that, you're doing it wrong.
Well, I'll give you another quick example. It comes in the form of Robinhood, which was having a great year stock-wise until obviously the last couple of weeks. Stock went from 25 down to 16.5 or so. And, if you look at where we traded down to, Dan, to Danny's point about opportunities, it's the same low we made back in May. So the market will provide you with those types of trading opportunities.
Well, they reported, I think, Wednesday night after the close, and it was pretty eye-popping. Half their revenue in the quarter, I think they had over $600 million in the quarter. Half of that was options, and another quarter was crypto. And, it's interesting. You don't need just the market going higher to get those
They're
sorts
gathering assets
get,
too at a rapid clip.
Yeah,
by
to
the
get
way.
that. So that's great for them
Yeah.
and net interest and,
Yeah.
and all that sort of stuff. So it's interesting because options is one of the last bastions of margin in this business, in the electronic trading business. So, interesting one. Guy, you and I have had our finger on this one, at least on the pulse of this one for the last few months, because again, we see them taking share against some of the larger.
Vinny and Porter own this thing.
Yeah.
We talked about it with them. Yeah, I mean,
the big short guys.
the big short guys own it, so it's good.
Well, we're going to talk to Dennis Debusschere in a second. I'll just end by saying this. That At Fillmore East album, again, 1971, double album. How many songs, Dan Nathan, on a double album, you're a music aficionado, do you think were on that album?
There's usually like 24 in a double album.
Typically.
Yeah.
Danny Moses, you want to throw a number out?
28.
28. You're both wrong by a multiple, by the
Was
way.
it
And it just
16 to 10-minute long
shows
songs?
the genius of
Yeah.
the Brothers Allman, because there were 7 songs on that album. And the second side of album 1 was You Don't Love Me for 19 minutes. And the second side of album 2 was
I'll see you in the
Whipping
bathroom.
Post, which went for 22
Whipping
minutes.
Post, yes, that
Yeah.
is the epic one. Just to be clear, Danny's guess of CBGB's, okay,
Very good.
which is down on the Lower East Side. So that is a John Varvatos store. You don't know who he is. You don't know what that is, right? It's like meant to be like a rock and roll like gear, that the rock and
Gear?
rollers would like apparel, right?
Apparel,
Like
apparel,
like clothing,
apparel.
right? And so now that's what that is. And they're meant to be really rock and roll. But I will tell you this, on the 25th anniversary of CNBC, remember they had that really fancy party up in Lincoln
Yes.
Center? So I went in there and I ditched it. I did the Irish goodbye.
Sure you
know
did.
why? I was going to John Varvatos at the old CBGB's, and Jimmy Page was there signing books. And I had an invite to that, and I left that fancy party. I got to shake his hand. Wouldn't you call it the hand of God?
Well,
guy?
I wouldn't say that, because John Lennon made a similar comment, and it was basically the downfall of the Beatles. I would say it's the hand of a rock god.
Imagine
Okay,
how
there you
excited Jimmy Page was to shake your
He
hand.
was
though, Dan.
cool, man.
Yeah.
I got to tell
Yeah.
you, he looked at me and was like, I get you, guy. You know what I mean? Like
He said, "Guy."
no, he didn't say.
He
You know how like
confused
someone
you.
would say, guy, yeah.
Anyway, check out.
Big fan of the show, by the way.
Of course he is. At Fillmore East, 1971, one of the great live albums of all time. As I mentioned, side 2 is You Don't Love Me. Well, I love you, Danny Moses. I love you, Dan Nathan. And in a minute, we're going to show some love to Dennis Debusschere. So stick around.
Welcome back to On the Tape. We are honored to have Dennis Debusschere back with us, the president, founder, and chief market strategist at 22V Research, 22V Research. I was lucky I just attended your last conference. We're going to talk about that. Timely to have you here. We had you here in July of last year, and Guy and I were in here begging, like, Dennis, it's a recession, right? You're like, no, I don't see it. You're at least not for the next 6 months. So you were right on that. We're going to talk about that. You're right on the rotation, although I'm guessing your viewpoints have changed a little bit since then, but we're going to get to that. So without further ado, welcome back to On the Tape. Great to have you back here.
Thanks for having me.
It was great having you last time, because you sort of got us thinking about a lot of different things. Danny and I had very similar views that did not come to fruition. And, you were the points you laid out made a lot of sense, very orderly in terms of the way you laid them out. And it all sort of worked out. Now, here we are in August. The world has changed considerably in some ways. In other ways, not so much, other than the fact that, maybe the market's off a little bit. What's different now than it was last summer?
The economy has actually slowed some. Like last summer, the economy was clearly much stronger than expected. The high frequency data was suggesting above like 3% underlying demand. Remember coming into last summer, there was a lot of SVB concern along with a high interest rate. Now what's different is you have seen a downshift in demand. I don't think it's a recessionary signal at all, but you have seen a downshift in demand, which, directionally is more concerning than, 3% going to 2% is obviously on the way to something potentially worse.
So Dennis, what are those data points you're looking at that you're making a decision whether we're slowing or growing, or what are those things?
Well, two things, right? The obvious one is labor market growth has slowed. The unemployment rate has moved to 4.3%, right? So your trend employment growth has slowed. It's still fine, and we can get into the details of that, but employment growth has slowed. Well, what I would say slowed, I would say normalized.
Right.
All right. So that's a really important point. The unemployment rate has increased. There's a chance that the unemployment rate, when it increases, it becomes self-fulfilling, even if it is for labor supply reasons, which is not a negative thing. There is some chance that it's not, and a high unemployment rate becomes self-fulfilling, and you get into a negative feedback loop. You didn't have that risk last year. And consumer spending has moved from a boom level, let's be clear about this, a boom level to something closer to trend. So last year you were running on a real basis now, because inflation was still high last year. It's still high, but it was much higher last year. Like 3 to 3.5% on real personal consumption expenditure growth. Now you're closer to 2. The pre-COVID period is like 1.25. You're more in line with income growth, so you should settle in around this area, but you have downshifted in consumer spending.
All right, so through our lens, it all has impact on the economy, and you're right in terms of the unemployment rate. I mean, we're not saying that the unemployment rate is some disaster of 4.3%, but the rate of change is concerning, and we've talked about SOM rules and all those different things.
Yep.
Whether or not it kicked in or not is debatable. It doesn't matter. The reality is we've gone from 3.4 to 4.3. I think on its way somewhere between 4.8 and 5%. Which historically is still not awful. But again, rate of change, is that something that's going to surprise the market, or is that something the market you think will take in stride?
I think if you go from 4.3 to 4.8, besides the fact that I would disagree, but let's just say...
No, I don't mean the next reading.
But if the market would take that negatively. I don't think there's historically, right, and leaving even the SOM rule aside, because that would be clearly triggered. You tend to have nonlinear increases in the unemployment rate. So I don't think you go from 4.3 to 4.8 or something above in a relatively benign fashion. So just the threat of moving up from here, this is why you have to be a little bit more less brazen in your non-recessionary calls. A little bit up from here is going to be taken poorly. 4.8, I would argue, is a lot up from here. So it's bad. Bad news is bad. I don't even care if the Fed is cutting aggressively against that. It's bad news for the market.
Does it scare you when we sit here today on Thursday that the market's now, we talk about micro-focused on certain points. I mean, the weekly jobless claims, for God's sakes, okay?
Yes.
So I know, how do you think about the unemployment rate itself about how it's calculated in general? Because I think you may have a different take than we see traditionally come out of some of the bureaus.
Yeah, so... a couple of different things as far as how it's calculated or what is driving it. More importantly, we don't have a lot of good information on labor supply and how it's impacting the unemployment rate. We know that there's been a significant amount of immigrants. When and how they matriculate into the labor force is like guesswork. What we do know is that the economy is still running at a well above recessionary rate. Up until recently, the unemployment rate had been lower and inflation had come down. So clearly there's something odd going on. Secondarily, what we focus on is prime age employment to population ratio. So your prime age workers, age 25 to 54, right? And where is their employment going relative to the overall population? And that made a new cycle high on the last report and is considered a better measure than just the straight unemployment rate. So you could sit there and say, okay, the unemployment rate is signaling a recession, SOM rule triggered, et cetera. And then I would counter and say, we've never seen anything close to a recession when the prime age working population has actually increased. So what do you do with that? Because we could come up with a rule saying, in this case, I would call it the Tedeschi rule, right? Saying like, this has never happened. So how do you counter with that?
What's that a function of? Because, you're countering the negative argument with that. What do you think what is that a function of, those numbers specifically?
That's a function, there could be twofold. I mean, there's been a significant reduction in temporary or household employment. We can argue about whether or not those numbers are reliable right now, but there is one of the arguments you could make, and I'm not sure how much we're all speculating on this point, so let me just say that over time, stimulus is worn down. Over time, you just can't live off your wealth effects, and you eventually have to find a job.
Yep.
Right. Let's put it that simply. That would be one potential explanation. Let's steel man that argument for a second. Assume it's true.
We saw that in some of the earnings we've seen. ZipRecruiter, I think, was pointing that out.
Yeah. So the good news then is, as that is happening, that labor is being absorbed, right? And if that labor is being absorbed, right, relative to the overall population, then you can't sit there and say we have an unhealthy labor market. That might develop over time. I get that for other reasons, and we can talk about those potential other reasons. But it's really difficult to sit here and say it's so obvious that the labor market is falling apart. Yet people really want that to be true.
Well, let me ask you a question. So you track the ISM numbers.
Yes.
The goods versus the services.
Yep.
Services continue to be stronger than goods, but it's hard to refute the slowdown in goods. I mean, it looks like the inventory levels, the thesis has been inventory levels get down, then they get replenished.
Yes.
We're not replenishing right now in there. So how do you weigh that into your thoughts about a recession as part of the data mix that you kind of look at?
Yeah. So first and foremost, when thinking about the ISM, so I want to make it very clear right off the bat that the goods economy is not doing great by any means. I think the manufacturing ISM is overstating the weakness because if you run it against IP, like actual hard industrial production data, there's a significant difference, right? And the IP data is not like gangbusters, but it's just not telling nearly the negative story that the ISM is. So just keep that in mind. Secondarily, the goods economy, there's a couple of reasons this might have happened, but for now, let's call it the first part of this year when many people thought that you'd see that replenishment, higher interest rates was commonly cited, right? So that interest rate increase at the start of the year, along with China slowdown. Now, in addition to that, I would add that almost in like a Y2K fashion, which I think all of us are old enough to remember, the over-ordering that happened into Y2K and the overhang on the tech economy that had for many years, we probably shouldn't dismiss the goods boom that happened post-COVID when we all got checks and could spend it on basically nothing but goods. And I say this as a joke, but I don't know how much coffee I have to spill on my couch before I finally buy a new one. I don't know when the Pelotons are going to get worn out. I don't, so there's a little bit of that could be going on related to post-COVID anomalies that are underappreciated, which gives you false signals on any given data point relative to history.
So along those same lines, again, kind of the stimulus that was brought into the economy, not just stimulus to the consumer, but the BTFP that came in to rescue all the banks and stuff that has kind of feels like we've kind of gotten through that now from a savings rate perspective on the consumer, which I know you kind of track here. What inning are we in then in that form with kind of, it feels like we've run through it now and people are getting a little bit extended. There's two different economies, I guess, here is what we're really talking about here.
So I guess to put it in inning terms, probably sixth or seventh. The caveat with innings, as you know, the ninth inning can go on forever. So, but that dumb joke aside, savings rates at a low level, income is coming down. Income is probably going to come down to roughly the 2.5 to real income, real personal disposable income will probably settle in the 2% range. You should expect the savings rate to stay around current levels, which means your consumer spending should, without a shock or a monetary policy mistake, settle in around 2%, and that will just stay around, quote unquote, around those levels until the next recession. Later in the cycle, to answer your question. So it's behind, the best is behind us. Consumer spending is shifted down, and don't expect a significant increase or decrease from here.
We look at the inverted yield curve a lot here, and I know it's probably something you pay attention to, but not necessarily impacts your work all that much. But it's of note of this week that we went flat for a brief period of time after the longest run, I think, in history of an inversion. Meaningful or just noise, in your opinion?
I think it's to the extent that I think it's meaningful. I think it's meaningful that everyone's going to talk about it. I think the yield curve, and we talked about this last time, I know, in term premiums and the impact of it. You still have roughly measured, because none of this stuff is perfect, a negative term premium. So in reality, you're probably you're not actually, if you adjust for it, negative. You're more upwardly sloping. Futures market have a 3-month through 10-year yield curve turning positive 4 months from now, which is pretty interesting. Financial conditions broadly have not reflected anything close to a negative yield curve impact, meaning inverted yield impact on the market for a long time. So I think it's important insofar as maybe it impacts confidence. But as far as the reality is concerned, financial conditions have eased aggressively over the last year. They're not going to ease more because the yield curve is now steep.
Or steepening.
Steepening, so.
Because it's a bull steepener. There's a reason.
Yes. Yeah. So it's I mean, it matters for certain sectors potentially. Like we can get into banks. I know it's
we'll get into that.
Yeah, but the stuff that you have a history with, and no, but I don't.
Within that context, I know you focus on nominal interest rate versus GDP. So what does that equation look like right now? Because you track that. That's probably the more.
Yeah. So real restrictiveness essentially. So where are we on a real restrictiveness level? Just stepping back, there was a fist fight with the macro nerds over the last 6 to 8 months on what should we be focused on, the effective real rate or financial conditions, right? And so when the economy was very strong for the first 5 or 6 months of the year, it was all financial conditions. The real rate is completely, misleading. And more recently, given the increase in the unemployment rate and deceleration in inflation, you could make a much more credible argument that real rates matter. So to answer your question directly, clearly not as restrictive as they've been historically at these levels. But if I look at what futures markets are pricing right now, you're going to be at a 3.2 Fed funds rate by the end of 2025, right? So you're going to have a positive real rate unless the 10-year yield comes down significantly in a recessionary way. Financial conditions will probably ease along with that over time. So expect significantly lower real rates, which is really important if we avoid a recession now. All right, if we're going to get through this period of weakness in the labor market and the soft patch, if you will, or moving back to trend in the economy, and I can tell you that, and the Fed doesn't, for some reason, change its mind, that basically, if I'm doing this podcast with you, hopefully you invite me back next year, we're going to have positive real rates, and we assume that markets discount in some way, shape, or form. That's a really positive thing for cyclical assets.
Which we're seeing. So let's turn to the banks because until this week, and this week, again, it's not over and it's just a bit of a blip, these banks have traded extraordinarily well. JP Morgan, all-time high. Citibank off of trough levels. Even Bank of America got up to a multi-year high, given some of it back. But is the environment conducive for the banks now, given the fact that seemingly, in my opinion, just my opinion, they priced a lot of good news in already?
Yeah, I guess my caveat would be I'd be going down to the riskier banks, right? So you'd be thinking more of the regional and smaller bank level versus the JP Morgans of the world, if you assume our forecast is correct of a steeper yield curve, non-recessionary scenario. One of the things we spend a lot of time tracking is different industry groups' performance relative to macro variables. And one of the things that's interesting to us, at least, is that relative to the less inversion of the yield curve and now potential steepening, regional banks in particular performed really poorly historically. Now that makes sense if you believe 10-year yields are going to crush the economy and or recession risk is high. So if you end up in a true soft landing scenario, Fed cutting, reacceleration in economic growth 12 months from now, you should expect regional banks to normalize, quote unquote, normalize their relationship with the yield curve. And there's a significant potential catch up there. JP Morgan reflects that, to your point, and it'd still do fine. But that's why you would want to go down to the riskier type of banks in a soft landing scenario.
Which makes sense given the fact that, again, everything you said leads me to believe that small and regional banks should do really well, given their underperformance and given some of the headwinds out there that they theoretically could face in the form of the unemployment rate going higher, servicing. I get it. So under your scenario, probably one of the best trades out there, forget about small caps, although that's probably one of them. It's these small and regional banks that a lot of people still think have a bullseye on their back.
Barring a recession, however. I mean, if there's a recession here, they're the worst ones. So the highest beta to the negative.
So what I'm saying is twofold: no recession, and so then a normalization.
So I already got the answer to that question. So we're back here again. You don't see a recession happen.
Exactly.
Okay.
Yeah. So I would say we have actually pretty high conviction that a recession is not going to happen. So less so than last year at this point, but we have high conviction that there's not going to be a recession. And to make a long story short, I don't know if it's today. Obviously, the market's working. I want to lean into the recessionary view over the next few months. Just be very candid about it. Like, that's where I want to spend my time.
By the way, I want to jump ahead, and then I'm going to come back, because one of the best things you have done your entire career are these surveys. Yeah. And I had to leave the conference before I could hear the results of the surveys that came out. Last year, 80% of people were expecting a recession.
Yeah.
Can you tell me what it was this year?
Yeah, it was closer to like 20%.
Right.
Yeah.
Doesn't that scare you? Does that scare you a little bit?
If we did that same survey 2 days ago, it might have been back at 80%.
That's true. By the way, does it also scare you that people clamoring for the Fed emergency rate cut? That should scare you just as a market participant, that's where we got, and that's the moral hazard that we live in now?
That scared me insofar that people actually were clamoring and thought it was needed.
Yeah.
Right.
Right. I couldn't understand why there was Because think about what we had. I mean, yes, the unemployment rate went up, and I get it. And the Somme rule, quote unquote, was triggered. If it was unrounded, maybe it wasn't triggered, and I can't believe we debated that. Right?
Right.
You know, it's probably close enough for government work.
Right.
But you still had a positive payroll report. Like, we hired people on net.
144,000 jobs.
114.
114, sorry.
Which will be adjusted somewhere.
Private
down
employment
the-
on a 3-month moving average is growing at 1.3%. It's downshifting, but it's growing. And the net result of that was an emergency cut.
Well, I think that was the yen and then the spillover effect.
Oh, no. Yeah, what started on Friday, though.
Yeah. No,
You know,
it started on Friday because it caused our yields to drop.
Sure, yes.
Created the differential, which then created the craziness going on potentially in the unwind that was starting
But
to
an
occur in the
emergency
territory.
cut only makes that
Agreed.
unwind in yen
It's
work.
amazing how
Yeah.
many people went on to Investopedia and become experts in the yen overnight, by the way.
Yes.
So the inbounds that you were getting in the last week, let's say, the inbound, hey, Dennis, get me so-and-so from your team on the phone. Hey, Dennis, what do you guys think? What sector should we be allocating to? Like, what were the questions that you were getting most?
So it's funny because the week's been so volatile. It's evolved over the week. But on Monday and Tuesday was all about emergency cuts and what would be the triggers for emergency cuts, right? So because that's your question on the yen, essentially. Is this going to keep continuing? Because if they do an emergency cut, it might
Get worse,
continue.
right?
Yeah,
This guy talked about that on Fast Money.
Well,
on Tuesday,
I brought it. I brought it up that night and said it was embarrassing what Jeremy Siegel said about emergency. I said, "What is
people
the
want
emergency?"
the drug, but they don't want the Narcan.
You know, I said, if
it's
you,
crazy.
you know, what's the emergency other than the fact that the stock market went lower? I mean, that's their job is not to make.
I mean, if you're a growth investor, I get it. I guess there's an emergency. I mean, I joke because a lot of times I can tell you the type of policy people want by the type of investments they have. Like, what is their investment mandate? So,
But what's really interesting about times like this, when you get this type of volatility, is if you're playing poker, they flipped over their cards. Some of these investors. So now you're playing. So what did you learn in terms of the rotation that started to occur quickly? Because you could argue we're going to go through that rotation, maybe not to the degree that we just did, but you got to see a lot of what's underneath the surface when you peel it back. What did you garner from all of this? And as far as, I'll take it one step further, as far as right now, where you're pointing investors to kind of rotate and be exposed in, depending on their risk appetite.
Yeah. So quality tech benefits in everything that's non-recessionary because everything goes down in a recession, right? It might benefit relative. And as you know, you guys know, it's not as simple as being short small caps or regional banks that have already underperformed when you're actually going into a recession, because they might if they're your shorts and you're actually bringing down exposure, that is not necessarily a good thing when you have to bring things down, because your longs will come down quickly. And we all know that game. So the idea behind emergency cuts, what I learned to your point, was how overweight people were in the same damn quality trade.
Same factors.
Same factors. Yeah. So it's when I say quality, it's a factor.
Yeah.
Yes, exactly. So, and then one of the ways that you offset that is, potentially, because you don't want the tail risk associated with recession, is an emergency cut.
Yep.
Let me ask you a question. This is not political at all. Politics bore me. But if you were to go in the middle of Times Square and poll 100 people and ask them, what are we in the midst of? I would think the majority of those people would say some form of a recession based on what they're dealing with. And, through the lens of this administration's approval rating when it comes to the economy at, low 30%, it would suggest obviously something is going on that you're not seeing. So why are people so, I know it's hard to answer, but why are people so pissed off? I think it's the cumulative effect of inflation and some of the underlying angst that is out there. Thoughts on that?
Violently agree. When you look at the data, whether it's polling data, consumer confidence data, et cetera, it is very clear that the American people despise, hate, use whatever word you want to use, inflation, right? The Biden administration got zero credit for a full unemployment in an economy that came out of recession because of inflation. When you ask potential voters what they're most concerned about, it's inflation and interest rates, which are tied at the hip, as we all know. Consumer confidence data through this entire period, meaning since inflation really took off, has been terrible relative to actual spending.
Right.
And the confidence data is weak because of inflation, right? People hate inflation. So that is the absolute answer. So inflation coming down presumably will lead to higher confidence levels over time, assuming a recession is avoided.
I agree with that. So one of the things I've said, and I'm not, but when I start trying to connect the dots, the spending is robust because people are trying to combat inflation with, with credit and with spending. I mean, that's the only alternative they have. It's not that things are going so well. That's their only basically defense mechanism in this environment.
Well, I would quibble with that. Probably true at the lower end. When you look at the aggregate data, real personal consumption expenditure growth, its influence, if you will, on the change in growth, in that growth from actual credit. If you look at consumer installment debt and mortgage equity withdrawal, has actually been a drag. So credit has actually, in aggregate, we can talk about different income stratas, but in aggregate has been a drag on consumer spending. So if we actually saw consumers lever up, you would see spending increase. So I'm not sure inflation's forcing them to spend more. I do know that they certainly feel it. And if they feel it and they're unhappy about it, that's going to potentially impact behavior.
You would acknowledge, though, that there's so many I've been doing this a while. We all have. The cross currents over the forget about the last couple of weeks, the last year and a half, are things that I've never seen before.
I would agree with that. Yes.
So staying with that kind of theme here, people need to start playing the election. Their portfolio managers have to start allocating certain ways. We're kind of 50-50 in the market, in the betting markets right now in terms of what we're seeing. What would you tell people then if in the outcome, not predicting the outcome, but what's kind of the safest allocation?
So
let me say what under each scenario, what sectors would perform the best and worst?
So let me start with the big one, which goes back to the previous conversation. We know that people hate inflation. We know that, and we didn't even get into this, but one of the reasons why we have avoided a recession is the deficit.
Yep.
Because the other side
we're getting into it.
Yeah, the other side of the deficit is a private sector surplus. That surplus is why consumers have been able to maintain spending. It is harder, like it was the last time I was here.
That sounds like my kids in college, somehow deficit versus surplus for them. But anyway, please keep going.
Supply right now is going to be harder to absorb by the private sector, meaning treasury supply, because your level of neutral interest rates is above expected GDP, right? And so if you have an increase in the deficit from here, that increase in the deficit from here, that is inflationary. You have a term premium potential shock, like a Liz Truss moment, or what we saw in France, in the U.S. If one of the two parties sweeps and they actually put through their deficit increasing programs, Democrats would be on the spending side. Obviously, the Republicans would be on the tax cut side. So when I think about the election, I think about it very much from a tail risk point of view of if they actually were to try and implement their policies at exactly the wrong time, when the U.S. consumer already hates inflation, which is related to the deficit in a lot of ways, right? And higher interest rates, obviously. And how are they going to feel if we end up with a, 5.5% 10-year yield because we do some deficit spending at the wrong time and home prices go down aggressively?
That leads to my next question. So we've had two bad auctions in a row. The 10-year yesterday and the 30-year, as we sit here, was bad again today. So, and these are down at lower levels, much lower levels than we've seen with the rates coming in. So when does that matter? Let's get into the deficit. When does that matter? Because we spent a lot of time at your conference last month talking about this, and it seems like the audience wanted people to care, but no one seems to care yet. So when does it matter?
It matters. Well, there's two ways that it matters, but if inflation were to go back naturally, it would absolutely matter. Okay, so if inflation goes up, and interest rates adjust to that inflation, then your expected deficit increases meaningfully over time because of where the current level of interest rates is to expected GDP growth. And then it goes back to my first point. You can survive right now in a divided government if programs roll off over time, meaning the deficit would not be a non-issue, but it wouldn't necessarily be an issue. So, i.e., we don't necessarily care as investors. You don't have a potential term premium shock, all things equal. It really matters if one of the parties sweeps and they actually try and implement a deficit increasing program. It will absolutely matter in our view.
What do you make of, we're talking about it around the surface, but Warren Buffett, probably the biggest cash holdings he's had in quite some time, sold out a majority of his Apple stake, pared down some Bank of America, sitting on a hoard of cash, more treasuries in the U.S. government. I mean, I can rattle the things off.
Yep.
Cautionary tale, or just sort of just anecdotal and not all that important?
I think it's a cautionary tale. I don't know if it means a significant drawdown. I think it's pretty consistent with the way we view the world as forward returns are kind of unexciting.
Mm-hmm.
So we did a fair value analysis on the S&P today using, if you know Aswath Damodar and NYU's Stern School professor. So just kind of classic DCF.
Comes on our show.
Okay, so classic DCF of the S&P. We use some tweaks relative to what he does, but you assuming earnings hold up, 10-year yield around current level, equity risk premium around current level, you're looking at a whopping 5,600 fair value, 8% upside, right? As of this morning.
Which where we were 2.5 weeks
right,
or so.
Exactly.
Yeah.
And if we go in a recession, what are we, 20, 30% down? Right? Your skew is pretty negative. Assuming, recession odds obviously are probably 15 to 20%. So I'm not that excited about the market. I'm really excited about internal moves. I'm really excited on banks or regionals on a relative basis. I'm really excited about dislocations and factors because people lose their minds over recession risk or not, and how to take advantage of those dislocations. But as far as the overall market is concerned, I think it's a pretty unexciting seventh inning like returns.
You guys have a very good energy group that at 22V, and it's a very important sector for many reasons. It has geopolitics in it. It's got China demand in it.
Yep.
What are you guys' current thoughts on oil and commodities?
So on oil and commodities, for the time being, I would say in the next 2 to 3 months, you're probably looking at a range bound around these levels. And then over the next year, you're looking at $80 to $90 a barrel. And that would be long energy.
There you go. And then how much has private credit kind of obfuscated real economy stuff? Because you talk about the banks. I mean, the banks don't have the loan growth.
Yep.
They're also not going to have the issues potentially of lending late in the cycle. So how do you guys think about the trillions of dollars which have come into private credit here? And how does that, because it's not measured, right?
It's not, that's the problem that makes it difficult to forecast with any type of certainty. And not that we ever have certainty in this business, but we think about it all the time. And I guess I would put it into the known unknown category. So what I would say is I view private credit as a potential accelerant to a recession, right? If we were to say, if you hear us, 22V, come out and say, yeah, we think the recession is going to be like 0 to -1%, you should probably call me up and be like, you're an idiot because you have these potential accelerants there that we just don't even know how to measure. So how could you be confident that you could have a 0 to 1%, -1%, growth outlook when you know there's a whole bunch of lending that goes belly up that we can't even necessarily measure? We have the aggregate data, but we don't know really where it is, or at least I don't. And so if we say that, yell at us.
Go ahead, Danny. No, I was going to say, what's the trigger for those? What's the trigger for that type of event, in your opinion?
It's an outright recession. It's the business cycle going in reverse. All right, just think about what a recession is at the end of the day. If you're doing -2%, NBER defined, they'll do it late, obviously, but it is the business cycle in reverse. It is 7+ unemployment rate. It's cutting jobs aggressively. It's companies not being able to meet their debt obligations, and the negative feedback loop that's associated with that. That's what that is.
I don't think people understand that aren't involved in the markets. And I have nothing against private credit. I'm happy for all these private equity firms that are raising capital. Good on them. They're raising capital because the demand is there. But the problem here, they're paid to put that money to work.
Yes.
They're going to get paid a management fee off of the assets that they gather. So of course they're doing, quote, underwriting. But if the demand, they're just going to fill up the coffers and put it to work. And I think the same way, and I'm not comparing mortgages to any of this, but because there were buyers, insurance companies and pensions that were buying these mortgage pools because they were, quote, AAA and they were 6% and they were, quote, guaranteed, it allowed Wall Street to keep doing this. So you can pick on either side, supply or demand of the equation, but it feels like that's kind of where we are. And to your point, the same way that the stimulus had an impact on the consumer and then the Fed doing their thing has an impact on the markets, private credit is potentially have an impact on elongating this cycle.
Yes,
I guess
absolutely.
is what you're saying. So
and we've been able to manage through that, right? So if you look at private credit returns over the last few years, been less great, but nothing's impaired. They don't have to worry right now, and they're getting more money, right? And they're putting more money to work. And to your point, let's just go back to the known unknown. We just don't know what the what the risk is.
Another area that I feel like it was a boy who cried wolf was commercial real estate. Why people say, oh, it didn't blow us up. It's fine. It's been, again, an elephant through a mouse hole to a degree. And
Yeah.
seeing some of the banks. So where are we on the commercial real estate aspect of either drag on the economy or marks still coming, or what's happening? Because it feels like it hasn't had the impact that people.
Yeah. So where we have a strong view is that the impact on the economy is minimal, right? Because it's not related to firing of people, right? So people are working in the commercial for companies, and they might just be working from home as opposed to going into an office.
Yep.
Or wherever they are. And so that's not having a large impact on the economy. If the marks become such a big deal for the banks that they actually start to see a cut in lending and a negative feedback loop develop, then it's a problem. Otherwise, I'm going to assume it's like almost what we were just talking about. It's a fire that is going to be more or less related to certain key properties in major cities that they're going to throw the keys back to the bank and they're going to find a way to deal with it.
Dennis, before Danny says goodbye, and again, thank you for joining us, good or bad, what's the one thing out there that seemingly nobody's talking about that's on your radar screen?
The consistent tightness of credit spreads, even in the move post-payroll and the Japanese yen / Nikkei crash, you saw, relative to history, a pretty mild increase in credit spreads all the way back, if you're looking at CDS and or high yield indices, all the way back to April of this year, which we know was not a treacherous time by any means. And still well below October of 2023, which was, a little bit more of a concerning backdrop.
And that gives you more faith that the real economy is still okay because credit spreads aren't widening to the degree that you would think they would from a move like that.
I wouldn't be leaning into a recession call and buying pharma and utilities hand over fist when credit spreads are tight based on a recession.
All right, well, listen, 22V, passion, integrity, excellence. Last one is collaboration, right?
Yes.
So those are the four. Okay. So you guys, bring a lot to the table. I know your firm continues to grow. I know you guys have made huge inroads in the last several years, and you are the leader of the firm. You've done an incredible job, and it's great to have you on here. I would like to do more than once a year. If
I would love it.
We can collaborate on the last thing.
Should be quarterly.
Yeah. So really, really thank you for coming.
I didn't want to invite myself back.
Yeah. No. Please. Great. So Dennis, thanks for being here.
Thank you, Dennis.
Yeah. Thank you so much.